Saudi is acting, with the four countries that did most of the cutting: Saudi, UAE, Kuwait, and Iraq. They've cut almost 86 or 85% of the 1.16, and the clear push here is to ensure that underinvestment in the sector does not continue. So I think with the prices going down below 80, which has happened also once before, they recognize that this is important for them to step in and reduce some of the supply that's available. So I think it's a good move, because we have some very significant underinvestment in the sector. As a matter of fact, His Excellency Sohail Mazroui said this is a precautionary measure to ensure market stability. So if you look at investment in the sector, Jeff, last year in 2022 we saw 12.7 billion barrels of oil equivalent come onto the market, according to Rystad. That's a fraction of the 35 billion barrels of oil produced and a fraction of the 60 billion barrels of oil and gas equivalent produced. So we need to step up our investment to ensure this transition comes in a smooth manner, not in an unsmooth manner.
Would you anticipate, I mean, if, as you say, this is about putting a line under the price to maintain capex and investment, would you anticipate further cuts this year if we continue to see a reduction in demand?
It's hard to anticipate. They've done these two cuts in relatively short order. The dynamics of the second cut are probably more related to the market instability that came out of SVP and the liquidity in the markets, which caused the short-term impact of slower demand during the winter season and a warmer winter to have some slightly excess supply increases or storage increases over the period. So I see that as a specific reaction to a slight aberration in the market, because we've had a different market. So I don't see further cuts coming in the near future.
Just in terms of your production at this point, given that we've seen such high inflation for the last sort of 12, 18 months or so here, what do you now need to see a barrel of oil priced at to make sure there's decent margin in your production at EnQuest? I mean, what are you modelling for the rest of the year?
Our biggest increase has been the EPL in terms of costs, and but in terms of cost per barrel, I think we've seen about a $3 increase in costs. 15% of our costs are generally linked to oil prices. As oil prices have gone from the 50 to the 80 level, we've seen an increase due to that. Also, structurally, we have core inflation that's going up, so our people cost is going up. The cost of, as you know, the inflation in the economy is 10% in the UK. We see slowing inflation in the UK oil and gas sector compared to other oil and gas sectors around the world because of the slowing investment in the UK.